Oh man, it's been a while. What is up, my YouTube family? It is. It's been an interesting couple of weeks here. Obviously, I'm a home loan guy first, so I gotta, videos come second. Home loan guy comes first. Home loan clients come first. But there's just been a lot going on. There's been a lot of things that have happened. I was on national TV recently, so that was a bucket list thing for me. And I'm gonna share with you some information about kind of what went down with that. We got a lot to talk about today. We're going to talk about mortgage rates. The Fed is meeting tomorrow. We have inflation that's kind of going crazy. A lot of people are talking about some wild things. Derrick Evans here, VA Home Loan Specialist, NMLS 155010. I also made a switch professionally recently to become independent, not be married to a rate sheet, and that's providing some additional opportunities for my clients and just in general in the business. And I'll show you a specific reason why that's going to be beneficial here in the coming days if I'm correct about what takes place here in the mortgage bond market. So let's get rid of this guy here and let's move me over here. Get my preview in the right place. One-man band and so forth. All right, let's take a look. So for right at the moment, put myself in this spot now. Here's what's going on. Today was interesting. It was just kind of a light day, not a whole lot happening in the markets. We're going to look at all this stuff. You see bonds like, okay, well, the 10-year didn't move a whole lot. Oil's still right at $70. Gold just hanging out in that right under 1800 area. Crypto, I'm happy about today. I'm happy about crypto today because one of the things that had me a little bit bearish on crypto recently is how much it has correlated with stocks. And, that's one of the reasons why a lot of people like myself are in crypto in the first place is we don't want the correlation with stocks. We want it to be independent. We want it to run on its own game. So today was really, really nice to see, Bitcoin's up 3.5%, Ethereum up 3%, kind of across the board, while the stock market was down across the board. So that was a good sign. I would say that's a big deal. Otherwise, I was going to say something completely different about crypto today. So here's the segment that I did recently, One American News. It's definitely like a pro-Trump, Republican type station, and it's cable TV. I know one of the producers on this show. She knew me from back in the day. Amazing person. It was like, hey, you can come in and speak to this. I went, I did it. It was definitely interesting. I was caught off guard a little bit by some of it. But I think I did okay. I would give myself a B+. I'm going to put that link in there if you want to check it out. Listen, I come in about 3 minutes and 40 seconds. It's definitely like, hey, there's a lot of things that are bad going on. It's Biden's fault. And then I kind of tried to basically say, well, here's the actual problem. The problem is inflation. So I'm going to give you the real explanation that I have because I have time to. What's going on with the supply chain? You're going to hear that word a lot. Remember, I've said this many times. You're going to continue to hear this word supply chain. It's like the lesser of two evils. The administration is willing to fall on that sword because talking about inflation is like a no-no, right? If you talk about inflation, if the administration were to admit that there's massive inflation, it wouldn't allow them to at the same time say we should have trillions of dollars in stimulus, trillions of dollars in infrastructure, that we should print more money. So they can't admit to the inflation because it derails their plans to go spend more money, basically, and continue inflating. So the example I gave on the show was my car. All right. So the reason that we know that supply chain is caused by inflation and not inflation is caused by supply chain, here's how you know. And this is like big boy stuff. A lot of people have to go to college and probably still wouldn't understand this. I'm going to explain it to you in 2 minutes. Used car, my Tesla. I bought a 2015 Tesla Model S almost exactly 3 years ago. And I bought it for $38,000 with like 38,000 miles. That's how I remember. I bought $38,000, 38,000 miles. And it was a great deal. Bought it directly from Tesla. Today, that car is worth $52,000 with 60,000 miles on it. Okay. And that makes no sense. Now, for used cars, there is no supply chain, basically, right? There are some used car dealers and there's, dealerships, new car dealerships who have, used cars on their lots. But for the most part, used cars, you're either going to trade it in to a dealership to get another car, or you're going to sell it to a private party in your local area. That's typically how it's done, right? 99%, let's say, of transactions are going to happen that way. So there's really no supply chain. Now, some people would argue, but it's the supply chain that's causing problems with new cars, and the lack of new cars is causing a push for used cars to take place. And while there is probably some spillover there, go to any new car lot. Tons of cars. I was trying to buy a car, and they tried to tell me that recently. I was trying to get a new Tahoe, and they said, yeah, it may take a little while to get one. And they actually tried to push me to a used car. And then the next day they called me back and said, yeah, we can order you that new one. So, I don't buy that personally with my own experience. But inflation, is my car really worth more money? No. We all know that. This is the thing that's hard to explain about inflation. We all know that my used Tesla is not worth more now than it was then. So the fact that it costs more dollars shows you that the dollar has decreased in value. That's what it's showing you. The dollar has gone down in value, and now it takes more dollars to buy my older, more used, more mileage vehicle, the same vehicle. If you look at the price of my car in Bitcoin, for example, a deflationary asset, the price has gone down a lot since I bought it 3 years ago. A lot. So that's the difference. Deflation, inflation. We're so used to thinking that $1 is $1, but it's not. And when you have inflation in the room, which is too much money in the room, what happens is people will end up buying a lot of things they wouldn't have otherwise bought. If I gave you $1 billion today, I promise your spending habits would change. If we airdropped $100,000 on your household, I promise you would buy some stuff you wouldn't have otherwise purchased. That's just the way it works. When there's extra money in the room, there's extra money in circulation, more things get purchased. When more things get purchased, now we have supply chain issues because there's too much being bought. And with that on top of other things, labor shortages, vaccine mandates, there's other things that go into the equation. But that's the reason why we're seeing supply chain issues. You'll notice in this segment, if you watch it, the first 3 minutes is news stories from different local areas talking about supply chain issues with medicines and things like that. But none of those store owners are saying, yeah, we can't pay our bills because we can't get inventory in to sell to people. No, they're getting the inventory in. It's just flying off the shelves. And here's the reason why inflation is so demonic. It's a demon financial scenario because it feeds on itself. And once you get a little bit of fear into the equation, remember the toilet paper shortage during the COVID crisis, the original lockdowns, which I've told you more were coming, and just you watch. The mask mandate starts in California tomorrow. They're not done locking us down. I guarantee you that. So if you look at those kinds of things, once the fear comes in, okay, hey, oh, wow, you mean you can't get things at the store? Well, we better stock up. Now people are starting to buy even more than what they would normally need. So I'm going to put this link on there. Check it out. That's what inflation is. I don't know how else to explain it, but the fact that used cars are worth more years later than they were purchased for just shows you it's the dollar has been devalued. That's what inflation means. Dollar has been devalued. Therefore, your real estate's worth more money. Your used car is worth more money. That's what it means. Okay, so I'll put that link in there for you. Wholesale prices. This is a really good one if you want to get some information, some real data on inflation. Wholesale prices measure that rose 9.6% November from a year ago. Fastest pace on record. Fastest ever. It's inflation. Inflation is a real financial demon. I mean, it is the embodiment of something bad. It's like a fire in a forest. And it's something that we've got to stop. Oh, speaking of, Fed meeting tomorrow. Who can stop inflation? Who's supposed to stop inflation? Federal Reserve. That's what they're there for. I know they have a dual mandate and I have other things they're supposed to do, but the real reason they were created, the real reason they're there is to manage the currency scenario so that we don't have massive inflation. That's why they're always talking about inflation. That's why they want to keep it at that 2% number. We're at 6.8%. As of Friday, Labor Department released 6.8% year over year inflation. That is not even close to the real number, but it's way, way out of whack. The administration and the government would rather have you talking about a supply chain crisis than talking about this inflation because it goes against what they want to do. Now, the Fed has to take quick action now. Now, if they just listened to me back in April, this wouldn't have been so bad, but they don't watch the show, so they're not as smart as you are. And they are now, so many months later, so far behind. This is the problem with bow tie guys. This is the problem with economists. They are never ahead of the game. They're always looking backwards. They're always going to be late to the party. Whatever it is they're doing, they're always going to be late to the party, and that is very costly. The Fed will halt asset purchases by March and hike rates in June. Survey predicts. Okay, it's a survey, so that doesn't mean a whole lot. Well, I got something for you. Let me show you something. We're not supposed to have this. That's the reason why this thing is all jacked up. I'm just kind of blowing this thing up because I screen captured something I'm not supposed to have. So it is what it is. But I'm going to show you because I don't care. Come at me, Goldman Sachs. And what this is, okay, Exhibit 1. This is from Goldman Sachs. So this is Goldman Sachs Global Investment Research. This is their expectation. Now, Goldman Sachs pretty plugged in, yeah? Can we agree on that? They're pretty plugged in what's going on. Definitely tied into this government, that's for sure. We expect the FOMC to double the pace of tapering to $30 billion per month and to deliver rate hikes in May, July, and November. So they're seeing right here, they're going to say, hey, tapering is going to start, okay? $15 billion a month. They're going to reduce their asset purchases by $15 billion a month. Pretty significant. And then they're going to taper $30 billion a month shortly thereafter. Okay, then they're expecting rate cuts or rate hikes to happen here, here, and here. This is just a calendar. Okay? So that's what they're expecting. Now, that's a pretty specific expectation if you ask me. I'm not trusting this 100%. Don't get me wrong. But the fact that this, I couldn't even find a good copy of this anywhere online, even on the dark web. Like, this isn't something that's being circulated widely. So I'm glad that I was able to snag this. And now we kind of know, all right, well, this is what they're expecting. So the taper is coming very, very quickly. It's going to come hard and fast is the expectation here. And then you're going to see rates rise next year multiple times. Okay. So that's what the Goldman Sachs Global Investment Research document is showing us. Do we know if we can for sure trust this? We don't. We don't. They don't necessarily, they aren't going to be 100% correct necessarily. But as far as having an expectation, it's probably better than the CNBC survey. Although there's some value to that, and that's why I'm putting it in there. This just came out. This is only like an hour or two old. Federal Reserve expected to take a very big step towards its first rate hike. Okay? They're going to announce more rapid transition away from its easy policies, and it's meeting Wednesday, as it sets the stage for first interest rate hike next year. Okay, it's coming. They have to do it. One wild card that market pros are watching closely is what the Fed says about the $8.7 trillion balance sheet and whether it tips when it might start to shrink it. Now, what's the balance sheet? This is all the assets they've already purchased. So right now, the Fed is buying these bonds. So like when we look at mortgage bonds here, which I'm going to go through this in great detail today, I'm going to show you the good, the bad, and the ugly on what's going on with mortgage bonds and what I expect to see from interest rates here in the near future. That's going to be the next thing we talk about. And so they own tons of these bonds right now. They're buying them. When are they going to sell them? That's the question here. The wild card. When are they going to lighten up that $8.7 trillion balance sheet? Because at some point they have to sell some of that stuff, right? When is there going to be enough strength in the market for the Fed to go from being a buyer to being a seller? That is really a big question. Now, I don't think we're going to get any information on that tomorrow, but it's something that is definitely, if it is mentioned at all, will spook the holy hell out of the markets. I mean, tomorrow could be a crazy day in the financial markets. Could be just crazy, especially if the wrong things are said. So I want to prepare you for that. I just want you to know when you look at the market and you wake up tomorrow and you look at your 401k, it could be ugly. It could be good. We're going to talk about a couple of things there in just a second. Here's one I'm going to include in the description. Rents going up again. Here's why. Listen, the reason that rents are going up is just because we have a housing crisis across the nation. We haven't built enough homes. We're millions and millions of homes behind. It's getting harder and harder to build. The easier places to build are already used. It's hard to build affordable homes. So a lot of the new homes that are being built, a lot of the new inventory that is coming in is expensive, which means that typically renters aren't renting those kinds of homes, right? It's people who could buy that are just in a temporary situation that are renting those homes, or people who obviously could buy are buying those homes, but a lot of renters are getting the second or third tier product. So there's some good information in this if you want to check that out too. This was just super weird. So Diana Olick writes this article, How to Take Cash Out of Your Home When Mortgage Rates Are Rising. How to take cash out. This is a stupid thing to say. It's not that hard. It's the same process no matter what. If rates are going up, okay, which they have been, I'll show you. Although today, last couple of days have been great, especially for VA. VA and FHA have been very, very low. Conventional rates have gone up a little bit. Harder to get in the twos now with no points. But I'm going to do a lot of rate-oriented videos in the near future, especially depending upon what happens tomorrow. I'm going to actually show you how a rate sheet works and all that stuff in the near future here. Borrowers had a record $9.4 trillion in tappable home equity collectively. So the end of the third quarter, there's almost $10 trillion in equity in the homes out there. So how do you, that's on average $178,000 per homeowner, which is crazy. So there's tons of equity out there, but what do you do with it is the question. It's not how do you tap it? How do you take cash out? No, that's easy. It's the same process it's always been. The question is, what do you do with it? Are you paying off debts? Are you investing into something else? Don't take cash out just to sit on cash. You better have something to do with it. So I know some people recently have been, this has been we've been talking about ADUs. Some people have been taking money out to buy these like Gulfstreams, I think they're called, or like, sort of like a trailer thing that you could sleep in, putting those in their backyard, Airbnb those things. You can buy one for 30, 40, 50 grand, nice one, put it in your backyard, Airbnb it. Genius. That's something worth taking cash out for. If you've got high interest debt, you've got something that's boggling you down, you need to pay somebody off, ex-spouse or whatever. Okay, those are all things where, yeah, sure. You need to do it just because you need to, more of a necessity. If you want to do it from an investment, you want to be more aggressive with it, then you just got to have a good game plan first. And rates are still totally good enough to do it. But if you're going to take a cash out on your home and get a higher rate than what you have on it now, you really got to take a look at what your cost of capital is and see if there's a better way to do it, which there could be. And so that's something I can walk through with you. If you want to shoot me a call or an email, I'm happy to do so. This one, I just want you to check it out because now they're really making it easier to get loan forgiveness. So there's lots of jobs that qualify for this public service loan forgiveness. And this kind of shows you how to figure out if yours does. So I just wanted to put that in there today because I thought this was a really helpful article and some good information. This guy, who says, I don't know if you can see this, kind of small. He says, not buying a home is a no-brainer. He's a Shark Tank winning CEO. I'd rather rent and invest the money. Well, if you're a super savvy investor, maybe you can make that make sense. But when do you stop renting? Because what guys like this, what they don't tell you on the headline is that his goal would be to save money by renting something cheaper than what it would cost to own, which lots of different ways to do that math and see if that makes sense. And then taking that money that you save, investing it, getting a big return on it, which has to outpace the appreciation of the real estate you would have owned, has to outpace the tax advantages that you would get on it, the principal that you'd be paying down every month. You've got to be a really good investor just to catch up to that, much less go beyond that. But if you are, let's say you're a great investor, you're the best investor ever, you're Warren Buffett, reborn, you would still, at the end of the day, buy a house with your investment proceeds. You would. And that's what they don't tell you on here. I guarantee you, if I were able to interview this guy, that's what he'd say. So yeah, eventually I'll buy a house with the cash that I've made. Okay. Well, why would you wait? And then now you're not leveraging anything. Now you're pouring all this cash into a house that you're the best investor in the world. What sense does that make? If you're really that good of an investor, would you ever want to let go of your cash? No. Well, then you can buy a house with minimal cash. You can leverage getting a loan. So it just doesn't make any sense. So stuff like this, I want to point it out because it is something we should tackle head on. Anytime somebody's got like, hey, here's my idea of what I think is best, we should listen to them. We should look at it. I'm just telling you, I've gone down this road many times and it doesn't make sense. All right, let's take a look at mortgage rates here. I wanted to zoom out. This is what's really interesting about tomorrow with the Fed. And, I'm going to wake up in the middle of the night, probably sweating bullets tonight, just because so many things could go wrong tomorrow, depending upon what is said by Jerome Powell. I mean, it's so crucial. The market is on the edge of its seat. I mean, talk about pins and needles. And what we really have going on right here is you can see the overall downtrend has been cascading. So this goes back to January up here. You know, if this is like February right here, late January, when the downtrend began, we had this immediate reaction, which was really, really ugly. And the market just sort of corrected itself. The real downtrend is up here, right? And so once we got back up and touched that spot, came back down, and we're never able to revisit that downtrend again. In fact, created a new downtrend over here. And, you know, then that kind of got oversold a little bit, retreated back up to that downtrend, and then got hit again. And now we're not touching that one anymore. We've created another one, which is even more slopey, if you will. The slope is greater on that one. And so that's what we're going to kind of zoom in on here right now. So let's zoom in a little bit closer. So the bottom line is mortgage bonds have been going down. Okay. When mortgage bonds go down, interest rates go up. That's the thing to keep in mind. So bond prices go down, interest rates go up. So we want to see this. We want to see bond prices going higher. We have not been seeing that all year. So rates have gone up this year. Now, if we zoom in a little bit, what are we looking at? Okay, here's the downtrend that we're looking at. We closed underneath it again today. Just couldn't break it, but I like this candle, and I do like a couple of things here. So I'm going to give you some of the good news. Good news is we have what looks like a double bottom here, okay, with a slightly higher on the right side, which is a good sign. We had a lot of weakness, though, after this consolidation, which wasn't good. And we've got this really, really slopey downtrend going on right here, which isn't really exciting. Let me give you a better look here. A one-man production studio, sorry. Oh my gosh. Robert's funny. All right. So, sorry, I'm seeing some comments. I can get to comments. If you guys want to drop some comments, I can get to those here in just a minute. So, you know, we're seeing this big downtrend here, and we've got the double bottom. So what you have effectively is we have a bear flag, okay, which isn't typically good. That's kind of a bad drawing, but that's what it is. So it looks like this thing's going to push lower. It looks like rates want to go higher, and rates really have to go higher in order to combat inflation. So my guess is tomorrow, most likely, the bond market gets murdered tomorrow. Now, I could be totally wrong, because what we don't know is we don't know what's been priced into the market already. We saw when we were zoomed out that there was a lot of, and by the way, inflation has been known by anyone who has any sense for quite some time. I've been talking about it since at least April, May, in this time frame here. So, you know, back here, maybe the people in the know who really know what's going on behind the scenes, they maybe knew, and that's why this happened. Okay, that could totally be why. Because remember, Federal Reserve was still buying bonds at a heavy pace back here when this horrible sell-off took place. So that's with a big, big, big buyer in place. That's a lot of selling, team. That's a lot of selling. So if that selling was able to take place with them as a buyer, then that just shows you what's possible now that they're going to be tapering and so forth. But is it priced in? You know, is this bad news already priced into the market? That's the big question. We don't know. It's possible that the Fed could come out and say what everyone's expecting them to say, and bonds could spike higher because, like, oh yeah, well, the sellers are already sold. Sellers have already sold. Anyone who wanted to sell a bond, they've had all year to do it. Everyone knows there's been inflation, not been a good job of hiding it. The powers that be. And there's no way to hide it. You can't hide the fact that your used car is worth more now than it was years ago. You can't hide that. So I think that it's going to be an interesting day. Anything could happen. I'm cautious. I tried to lock as many loans as I could today. You know, it's you don't always get to. You just try. That's all you can do is try. My seat. Sometimes people can't get to paperwork, or you know, whatever it is. You know, who knows? I'm praying for higher bond prices tomorrow, but I'm not optimistic. I am not optimistic at all about what the future of interest rates looks like. And I do think we're going to see rates go higher in 2022. And I don't think there's any way around that. I think they have to. They have to go higher, or this inflation is going to just eat up wealth like you've never seen. We're going to continue to see real estate prices go up pretty much no matter what happens to rates. So some people lately have been asking me, what if, if rates go up, that should cause prices to come down. I'm afraid that's not going to happen. Even if rates go up a lot, even if rates go up 1%, we're probably not going to see prices go down. Reason being, there's so many buyers, so many well-qualified buyers, so many cash buyers, so little inventory. In order for prices to go down, we need more inventory. The rates don't matter. They really don't. They're not having any effect. In fact, on a daily basis now, I can't tell you how few people ask me what rates are. It's funny because when rates drop and it's in the news everywhere, I get asked 50 times a day, but what's today, Tuesday? Between yesterday and today, I don't know if anyone asked me what rates are. So rates not at the tip of everyone's tongue, not the big thing. Payments obviously a big deal. People always ask me about payments, but rate itself is not the big mover. And we've got a situation where the inventory is so low here in San Diego that there's nothing that I can see that will stop prices from going up except more inventory, and a lot more inventory. So hopefully that's helpful. I expect mortgage rates to get worse tomorrow. I hope that I am wrong. Everyone should be prepared for this, though. Tomorrow could be an absolutely crazy day in the financial markets. Hopefully I'll have time to do a video tomorrow. If not, good luck to everyone out there. Either way, we're going to be talking about this for months to come. Merry Christmas, team. I hope I see you again soon. Let's see here. Your gold in their sack. Not in charge. He catches all the crap he's above. Yeah. Hard to argue with that. Feel free to drop comments, share this video, help make your friends smarter than everyone else. Appreciate your time. I'll see you guys soon.